Have you ever wondered how the housing market reacts when the Federal Reserve decides to raise interest rates? Traditionally, it's been a straightforward story. As rates go up, mortgage rates follow suit, causing home prices to fall. However, after 10 rounds of interest rate hikes, the housing market, which is usually quite sensitive to interest rate changes, has become a puzzling ordeal. It's causing a lot of confusion, says Orphy Devangi, a senior economist at Zillow. The Federal Reserve decided to raise its benchmark interest rate by a total of 5 percentage points since March of the previous year in an effort to combat high inflation levels, the likes of which hadn't been seen in 40 years. Here's the basic idea. When the Federal Reserve increases interest rates, it triggers a chain reaction. Banks start charging each other more for overnight loans. To compensate for their increased borrowing costs, banks and other financial institutions then charge consumers higher interest rates on mortgages, credit cards, auto loans, and other loans. The theory is that consumers, facing higher borrowing costs, reduce their spending, making it difficult for businesses to hike prices as they usually would. Before the Federal Reserve's first rate hike on March 16, 2022, the average 30-year fixed mortgage rate hadn't gone above 4% since May 2019, according to data from Freddie Mac. However, in anticipation of the Fed's decision to raise rates, mortgage rates began to creep up, hitting 4.42% right after the first hike. Mortgage rates continued to rise in lockstep with the Fed's interest rate hikes until they reached a peak of 7.08% in November, despite 4 more rate hikes occurring since then. So, what's going on with the housing market? Why have mortgage rates taken an unexpected turn, seemingly ignoring the Federal Reserve's interest rate hikes? Mortgage rates have been on the rise lately, reaching 6.81% for the week ending July 6th, the highest point in the year, according to Freddie Mac. Interestingly, during the same period, the median price of existing homes dropped by 3.1% compared to the previous year, as reported by the National Association of Realtors. However, monthly data showed a 2.6% increase, marking the 4th consecutive monthly rise. New homes had a median price of $416,300 in May, reflecting a 7.6% decrease from the previous year, but a 3.5% increase from the previous month, according to the U.S. Census Bureau. So, why have mortgage rates stopped responding to the Fed's rate hikes? Charles Dougherty, a senior economist at Wells Fargo, explains that the Federal Reserve's monetary policy is just one of the many factors influencing mortgage rates. Another significant factor is the yields on 10-year Treasury notes, often seen as an indicator for mortgage rates. However, in recent months, the gap between the 10-year Treasury and 30-year fixed mortgage rates has widened. This divergence is attributed to the uncertain economic outlook. Inflation remains above the Federal Reserve's 2% target, which implies that more rate hikes may be on the horizon. Still, without a clear understanding of the potential impact these hikes might have on the economy, the Fed may unintentionally usher in a recession, according to Dougherty. The complex interplay of these factors has made the behavior of mortgage rates quite unpredictable. Long-term interest rates are like fortune tellers, trying to predict not only the Federal Reserve's next move, but also the possible interest rate trajectory over the next decade. These rates are the focus of anticipation, as Len Kiefer, deputy chief economist at Freddie Mac, points out. He suggests that while mortgage rates might react to the Federal Reserve's next rate decision, the outcome could be quite paradoxical. Imagine this scenario. If the market begins to believe that future rate hikes are becoming less likely, it could exert a downward force on mortgage rates. In other words, mortgage rates might drop even if the Federal Reserve raises its policy rate, according to Kiefer's explanation to CNN. In theory, when mortgage rates rise, it should put downward pressure on home prices because it becomes more expensive to own a home, which would typically reduce demand. However, that's not what's happening in reality. One reason for this phenomenon is the significant lock-in effect caused by the higher mortgage rates following the Federal Reserve's rate hikes, as Kiefer suggests. At the beginning of the pandemic, the Federal Reserve took dramatic action by lowering interest rates to nearly zero, aiming to boost the U.S. economy as businesses closed and people stayed home to curb the spread of COVID-19. These ultra-low rates allowed homeowners and potential buyers to refinance or purchase homes at rates as low as 2%. As mortgage rates are edging closer to the 7% mark, a significant shift has occurred in the housing market. The prospect of selling a home now means potentially swapping a low mortgage rate for one that's nearly twice as high. Len Kiefer explains that many current homeowners are reluctant to part with their mortgages under 4% in exchange for rates exceeding 6%. This sentiment has played a role in the diminishing housing inventory. Moreover, since many homes are still listed at prices above their pre-pandemic levels, homeowners lack the incentive to sell. Consequently, it appears that the supply of homes will remain limited for the foreseeable future, according to Charles Doherty. Housing inventory, or the number of active home listings, has decreased by a third since before the pandemic. In June, there were about 614,000 existing homes listed, compared to nearly 928,000 in February 2020, based on recent data. The housing market is still trying to catch up from the aftermath of the Great Recession, which led to nearly a decade of sluggish new home construction, as pointed out by Orfa Devongi. Although home builders began to pick up the pace when mortgage rates dropped below 3% in 2020, they couldn't keep up with the sudden surge in demand caused by the pandemic. Furthermore, the low volume of listings combined with strong demand for home buying during the spring is expected to drive home inventory even lower, according to Zillow's Devongi. This situation is further compounded by the robust labor market, with workers earning more than they did before the pandemic. All of these factors contribute to the current unique dynamics of the housing market. In the present day, the American housing market faces a host of challenges, each interconnected and influencing one another. One pressing issue is the rising cost of housing. The demand for homes, fueled by low mortgage rates and population growth, has led to soaring home prices, making it increasingly difficult for many Americans to afford a home. This affordability crisis is particularly acute in major cities and metropolitan areas, where limited housing supply exacerbates the problem. The shortage of affordable housing is another critical challenge. The gap between supply and demand for affordable housing units has widened, leaving many low and middle-income households struggling to find suitable and reasonably priced homes. This scarcity not only affects individuals and families, but also contributes to homelessness, as many cannot find affordable shelter. Furthermore, the aging housing stock in America is a persistent challenge. Many homes and rental units are in need of maintenance and repair. This not only affects the quality of living, but also has environmental implications, as older homes may lack energy-efficient features, contributing to higher utility costs and a larger carbon footprint. Zoning regulations and land use policies play a significant role in the housing market's challenges. Restrictive zoning and land use practices can limit housing construction, driving up prices and preventing diverse housing options. These regulations can also contribute to segregation and inequality in housing, perpetuating disparities among different socioeconomic and racial groups. The COVID-19 pandemic brought about its own set of housing challenges. On one hand, it accelerated trends like remote work, causing shifts in housing preferences. More people sought larger homes, properties with outdoor spaces, and suburban or rural living. On the other hand, the economic impacts of the pandemic left many individuals and families struggling to pay rent or mortgages, leading to concerns about potential waves of evictions and foreclosures. To address the housing challenges in the United States, a multifaceted approach is necessary, one that takes into account the interconnected nature of these issues. Improving housing affordability is a critical first step, as it can have a ripple effect on many other aspects of the housing market. Encouraging the construction of affordable housing units is key to making homes more accessible to a broader range of Americans. This includes offering financial incentives to developers and increasing funding for affordable housing initiatives. Additionally, promoting homeownership can be achieved through various measures, such as down payment assistance programs and accessible mortgage options. These policies empower individuals and families to build wealth through homeownership. Zoning reform is another essential component of the solution, as it can help address both supply and affordability concerns. By relaxing restrictive zoning regulations and promoting mixed-use development, communities can expand housing options and lower construction costs. In parallel, investing in infrastructure, such as public transportation and utilities, can improve housing accessibility and reduce commuting expenses, particularly in urban areas. This approach not only enhances housing options, but also contributes to sustainable and well-connected communities. The role of sustainability should not be overlooked. Promoting energy-efficient building practices and environmentally friendly construction not only reduces housing costs for residents, but also addresses pressing environmental concerns. It's essential to encourage innovation in housing solutions. Embracing options such as tiny homes, co-housing, and accessory dwelling units can diversify housing choices and create more affordable opportunities for residents. That concludes today's video. Thanks for watching. Let us know your thoughts in the comment section. Until next time.